there's a little bit of a thing overclash that has happened. We have a session going on simultaneously at Thane at D.N. Bedekar College, which was organized by our Thane chapter.
All right.
So and it's a physical one, you see. So many members are taking the opportunity to go out and attend that physical session.
Sure.
On this and that too is happening after almost about 3 years. The event by BMA is being organized in a physical mode. So a lot of our EC members, a lot of our participants, members, they're probably in Thane attending. So whenever you suggest, Dr. Kiran, do you think we should start now?
Please, sir, go ahead.
All right. Good evening, all the members of BMA, other participants. Good evening. Good to see you all here for a wonderful talk by Dr. Tinaikar. BMA event, the Friday Fundamentals, is primarily oriented towards all those management lessons which the members are very keen to listen to from the different speakers who've always been with us and shared their experience and insights with our members. This particular evening, especially, is extremely exciting. Going to be extremely exciting for all of us, primarily because we all know that. I was just talking to Dr. Durgesh. Is we were wondering as to what is going to be the future of banking in India, and if at all it's going to be different, then what kind of future? For that, we have Dr. Durgesh Tinaikar. He's the IMC, Pravinchandra V, Gandhi Chair Professor in Banking and Finance at Jamnalal Bajaj Institute of Management Studies, Mumbai. Dr. Tinaikar has been a career banker with more than 3 decades of banking experience in corporate and investment banking. Has a huge amount of experience which Dr. Tinaikar carries. He's held senior positions both in India and abroad in several large international banks such as Standard Chartered Bank, Societe General French Bank, DBS, Mizuho Bank, which belongs to the Mizuho Financial Group of Japan, where he was the managing director and head of corporate and institutional banking. Prior to his superannuation just about a couple of years back in the month of March 2019. Dr. Tinaikar is a bachelor in engineering from VJTI. He's completed his MMS in finance from Jamnalal Bajaj and from the University of Mumbai, and is a PhD in international finance from one of the very well-known universities called the American University from Washington, DC. And he also has attended an executive MBA program in investment banking and corporate finance from Kellogg School of Management, Northwestern University of Chicago. During his banking career, Dr. Tinaikar received several awards, such as the Chairman's Special Award at Standard Chartered Bank and Mizuho Bank, President's Award in for several consecutive years at Mizuho Bank for his contribution to business and development in India. And I was just saying earlier is that everybody is wondering what is going to be the future of bank, especially in view of the attacks, what I would say, the UPIs and various other facilities, including the blockchain and the AI and the AR, VR, all things of which are going to happen. So there's a huge amount of increasing demand for digital banking experience, especially from the millennials and Gen Zs, and that's transforming the entire banking industry in India and abroad, and especially from the retail point of view as such. When I look into as a consumer, my own desire, and I'm sure that's the same that goes through with many other people also. Access to the financial services has become a kind of an important part of my life and our life as such. And therefore, the banking industry is reconceptualizing the way they function today. And they will probably function in another 10, 15 years time down the line as such. So banking industry, and I was just saying, Dr. Tinaikar, when the entire physical infrastructure collapsed, it was only because of the digital infrastructure was survived, and the banking industry kept on thriving and doing well, and ensured that the economy keeps on functioning as such. So despite all kinds of challenges, emerging technologies, and the new business models, bank, I'm sure, are going to put in a lot of new strategies to be able to survive by 2030s and ever in the future as such. Dr. Tinaikar, as you all know, is an expert, and he's here with us to talk about the future of banking, the emerging trends and challenges. And as he mentioned right in the beginning, is that his approach to this entire thing will be very non-conventional, not the ones which we probably see in the newspapers or read in the newspapers as such. So over to you, Dr. Tinaikar, and I'd like to thank you on behalf of our President, Dr. Kavita Lagate, our executive committee members, Dr. Kiran Yadav, the treasurer, he's here, and all other members for being with us today, and including the past presidents of the Bombay Management Association. Over to you, Dr. Tinaikar.
Thank you very much, Dr. Bigyan, for those kind words, and good evening to all of you. It's a pleasure to be here in front of you online to basically present my presentation on the future of banking, emerging trends and challenges. The hot topic today is basically whether fintech, right, whether it's going to collaborate or be a disruptive force for the banking sector, right? So a lot of discussions in banking today, future of banking, are focused on fintech because there have been certain disruptions. They're taking a lot of space from the retail banking, especially. But I've been a wholesale banker and I've spent almost 3 decades working for large international banks, which came to India around liberalization or just before that. And I worked with them to basically build up the India franchise, and primarily wholesale and investment banking. And therefore, when you look at banking, there are 2 segments here. One is retail and one is wholesale. You cannot ignore the wholesale banking. Retail, yeah, there's a lot of technology which affects the way you do business in the retail space, but wholesale is equally important. So what I'd like to do today is basically to tell you my side of the story in terms of my experience, that the future of banking does not necessarily depend on, or will not necessarily depend on fintech. But it will also depend on how banks adapt to changing environment, structural changes, as I call them, regulation, financial markets, and so on and so forth, right? And fintech companies, a lot of them are collaborating, in fact, with banks, as you shall see from my presentation. And I was reading a news report today in the Economic Times, which said that fintech companies may have lost edge, must generate profits. Many of them are cash burning, right? Including the largest one, Paytm, right? So therefore, my view is that they cannot survive on a standalone basis. They will have to collaborate with the banking sector, right? So let me now share my my presentation here. It's quite elaborate. There are more than 120 slides, but I will try to focus on the key ones. Okay. Is that fine? Is this visible?
Yes, sir.
Very good. So maybe I might just switch off my video just for saving my bandwidth, just in case. And I will obviously switch it on once my presentation is over, right? Or maybe I may just keep it on. There's no issue with me. But I thought that perhaps if there's any problem with the bandwidth, then I will save it. So the topic is the future of Indian banking, emerging trends and challenges. Okay. So,
sir, can you switch it to presentation mode?
Yeah, I have at share mode, right? Okay, one sec. I'll put it on a share mode. You can't see it. 1 second. I'll put it on a share mode.
No, we are able to see it. Just click on that presentation mode.
Okay. You want a full screen, right? Is what you're saying?
Yeah. That is what.
Well,
thank you.
Is that okay?
Yes, sir. Thank you.
So before we go on to the future, we're going to look at the financial health of the banking sector quickly, because a lot of things have happened last 2 years. There's the pandemic, right? How that has affected the banking sector. Then after that, I'll focus on structural changes, which I've seen in my career as a banker. Because as I said, my experience has been mainly in wholesale banking, in corporate and investment. I don't have any retail banking experience. The structural changes I relate to are the financial markets. Regulations have changed. Growth through consolidation, which you're seeing today, for example. And then you have priority sector lending and financial inclusion, which is a very important agenda for the banks. Then we have technological changes, fintech. You can, look at technological changes as structural changes, but I've, made a little different because technology obviously is the backbone of the banking system. But I thought I'd rather cover it separately rather than being part of structural changes. And finally, my conclusion. Okay, so that's how we go around. So if you look at the financial health of the Indian banking sector, I think this is what the structure looks like. All of you must be aware. We found here, so starting around Jan, here there's a drop in credit growth. That's because of the pandemic. But luckily, since November last year, 21, there's been a pickup again in credit, which is a good sign, right? And then the sectoral growth, which I think I will. So this is how the trend looks like in terms of year-on-year growth. You know, month-wise, we saw here 5.6% growth rate year-on-year basis. March last year, it was again picked up to 9.6. Okay, in March this year. So that's a very good sign. Then you're looking at deposit growth again. It was 11.4% in March. This March has slightly fallen. Doesn't really matter. What's important is the credit to deposit ratio. The higher, the better. Here you have 72.2%. The lowest we reached was in late 2016 because of demonetization. But this is okay. There's an upward trend, which is encouraging. Return on the assets. Profitability is equally important. Here you see there's a huge dip. This is combined for all SCBs are scheduled commercial banks, banking sector as a whole. And the blue line is for the public sector banks. So here it's fallen here, and then again, starting around late 2019 onwards going up, which is again a healthy sign. That's partly because there's no uptick of credit during that time. So a lot of banks made money by investing their surplus or their deposits in treasury instruments. Because rates were falling, the yields were, they're getting better returns, and therefore that's the reason why the treasury income has gone up, and that's why they're making money. All right. Likewise, return on equity, again, it's gone up. Problem here is this blue, which shows that the PSUs are a drain. Okay. Negative because of the write-off of their bad debts and so on, NPAs. Net interest margin is a very important parameter to determine profitability of the banks. So here we have, it's going up since 2017. Okay, this is for the banking sector as a whole. The blue line is for the public sector banks. Green is for the foreign banks. The orange is for private banks and so on. So overall, there's been a very healthy growth in the net interest margins. Then comes provision coverage ratio, how much you're provisioning for gross NPAs. And I think it's pretty okay. 68% is fine, making 68% provisioning, which is good enough. Most important again is GNP ratio, the asset quality of banks. You see here it is high, 11.2%, right? This is gross without writing off of your bad debts, and this is net, right? 11.2% has fallen sharply in September 21. And that's for two reasons. One is that banks have cleaned up their balance sheets, they've written off, and also they've got infusion of capital from the government, right? So this is gross and this is net. So I'll just skip through this. So basically what we see here is that, okay, this is in terms of the segmentation of the asset quality of banks. Where do the bad debts come from? Priority sector, 32.79%, right? Out of which 15% is from agriculture, 13% is from MSMEs, others is 4.78%, and the balance 67.2% is from non-priority sector. And same likewise in 2020-21, about 85% of the gross NPAs is on account of the PSU banks, right? The sum of these two is equal to 100. So therefore, we come to know here where exactly is the problem. Capital adequacy ratio is very important. Okay, capital adequacy ratio, capital to risk asset ratio, risk weighted assets, right? Now here it's going up, which is a very healthy sign. 15.8% to 16.4%. In fact, the Bajaj norm says it should be 10.5. RBI has prescribed 1% higher at 11.5, and we are well above that. So Indian banks are adequately capitalized thanks to the capital infusion by the government of India. So CRAR ratios, again, public sector, private sector, foreign banks are quite healthy. So overall, we can say that the Indian banking system is quite sound at this point in time. So the only caveat here is that as per the financial stability report of the RBI, they're likely to shoot up to about almost 8 or 9% by September this year. So there's been a lot of defaults on the retail side. Because of the pandemic, people have lost jobs and so on. They don't have money to to pay their retail loans, housing loans, and so on. So that's something that you need to keep in mind. But the good thing here is that the central government has infused capital into these banks. Okay, in 2014, it infused 3.43 lakh crores. In 2021, 20,000, another 20,000 in 21, 22, and now they're trimmed that to 15,000 in 22, 23. So net, I think the Indian banking sector is growing at a healthy pace. It's not that bad in terms of the financial parameters. In fact, I would say there's encouraging signs out there. Now, we have structural changes which I face as a banker. Being a wholesale banker is the financial disintermediation which is happening, which in fact is a blessing in disguise. Then come the regulatory changes, which actually has an impact on your business model that you want to build up over the next few years. And then the growth through consolidation. Recently that we're seeing a lot of PSU banks being consolidated, and also we have the HDFC and HDFC Bank merger and so on. We also have some banks exiting India. Let's look at the first one. Look how Indian capital market is growing. Here, 1990 liberalization happened around 91. But starting around 2010, this is the equity market, this is the debt market, and this is the sum. Debt market is still underdeveloped. Whereas if you look at the US and other advanced countries, the size of the debt market is much, much larger than the equity market. Okay, but there are signs, and what are corporates doing? Corporates are raising bonds. A lot of them are raising bonds, 5 years, 10 years, and so on. There's not much of bank capital there. There are institutional investors who invest. The fact is the bond market is growing, right? Number of issuances are also increasing. And these are mostly private placements, okay? Now, if you look at the cost of borrowing, right? So this is the MCLR. MCLR is the benchmark, marginal cost of fund lending rate, the minimum rate that is offered by a bank. And RBI very clearly says that you cannot lend below MCLR. There's an MCLR rate, and this is where the CP rate is. So a lot of Indian companies are relying less on bank finance, they're relying more on commercial paper. You see this? Including some of the mid-sized companies. And they get a good rating. They get A, P1 plus, or whatever. These are ratings that they've got, A1, P1, and so on. So short-term companies, especially the large cap and also the top tier mid-cap companies, prefer to raise funds through commercial paper, which is a short-term instrument, typically 90 days. So CP market is going here. You see that very clearly. And banks are also participating in the CPs. It's good for them because they are not committing their assets over a period of time. For example, 1 year. If a bank has to give a working capital facility, a working capital demand loan, we sanction a loan for, let's say, 1 year, and then we roll it over. But here in CP, it's a 90-day instrument. I participated, my choice, that's it. It's my choice whether I want to come in again or not. And more importantly, SEBI has come out with a rule that a large corporate should borrow at least 25% of its incremental borrowings made from financial year 2019-20 towards the onwards from the capital market. So that's a guideline. If you don't do that, SEBI may fine you. Okay, but SEBI does not really regulate banks, right? So therefore, I don't know if somebody were to go to court against this. I don't know what, but nobody's done that so far. So one, we look at how markets have changed. The bond market is growing. Many companies are relying on medium to long-term funds, especially the top-rated companies, the Tatas, the Birlas, the Reliances, and so on, borrowing from the bond market, and then short-term funding is from the commercial paper market, right? And most important are the Basel norms, okay? Basel Capital Accords prescribed by Basel Committee, and this is, Bank for International Settlements is the bank of all banks. And they came out with certain guidelines in 1988. Why did they come out with these guidelines? To ensure that banks have enough capital for the risk it takes to protect the bank against the risk of systemic crisis, to protect depositors who cannot monitor banks, and to promote transparency in banking operations. So they've had 3 accords: Basel I, Basel II, and Basel III. Okay, one was very simple: capital to risk weighted asset ratio should be 8%. And how do you then decide on the risk? It was only credit risk which was included while computing risk-weighted assets. You have certain models which help you compute what the credit risk is. Then came Basel II, which was an improvement. They said this is a one-size-fit-for-all. It's not good enough. We should also include market risk and operational risk. That's what they did. And therefore, which means you're providing more capital, which takes into account market risk and operational risk, right? And then comes after the GFC, global financial crisis, the crisis of all crises till now, right? Which happened in 2007. And they said, look, this is not enough. You got to protect banks which had too much of leverage, inadequate liquidity buffers. So you got to add capital conservation buffer, liquidity buffer, some leverage ratio, and so on, which in turn, what it does is it increases the denominator. And therefore, if you take 8% of that, you got to provide more of capital. And if you all know from basic corporate finance that equity capital is an expensive source of finance, right? So this is what Basel II, I don't want to go into technical details. This is Basel III and this is Basel III prescribed by RBI. You see here, Basel III prescribed by Bank for International Settlement said that overall capital to risk weighted assets should be 10.5. RBI said for Indian banks, it should be 11.5, 1% more. So RBI has imposed a more tighter control on Indian banks, right? And they also have something called a leverage ratio, right? How much you're going to provide core equity, tier 1 as equity capital plus reserves as a percentage of total exposure. 4.5% for domestically systematically important banks, which are basically SBI, HDFC Bank, and ICICI Bank, and 3.5. Compared to Basel's only 3%. So RBI's regulations have been more intense, more tighter on Indian banks. And Indian banks have achieved that. They're well above the RBI minimum norm. Most all the banks, in fact, you look here, 12.9, right? This was of 2020, 21 it was 14%, and all, including the individual banks have achieved the capital adequacy ratio. Their Indian banks are well above the minimum benchmark, both in terms of capital to risk weighted assets and also in terms of leverage, more than 4. Here, this shows how they're more than 4.5%. So thanks to RBI, which has been very prudent and they impose tighter regulation of Indian banks. Okay. So now, how does it affect my business strategy as a banker? You have regulations, you're tightening the rules on the banks, say more and provide more and more capital. If I look at my banking days as a wholesale banker in 1990s and 2000s, the business was asset heavy. That means I gave more and more loans. More loans I give, the more money, top line, and so on, my profits go up. So keep on rolling out assets. But after the GFC, and because of these regulatory norms, which have been imposed by Basel III, which has been a game changer, I'm not looking at just top line. I'm going to look at my return on risk-weighted asset. Because the moment I lend to a company, my RORWA rather goes up, and I have to provide capital. So I need to increase the numerator, right, which does not add to the denominator, increase the denominator. The only way I can do that is through fee income. If I lend, let's say 100 rupee, or let's say 1 rupee out of 100 rupees to a customer, I got to look at, how much more fee income I will get. I'm not just looking at lending, because lending consumes your assets. My RORWA goes down. The risk asset is in the denominator. My capital that I got to provide goes up. The only way I can achieve is if I give 100 rupees loan or 1 rupee loan or whatever, I got to ensure that I get adequate amount of fee income, right? So that on the numerator, I have fee income, I don't have to consume any assets. Therefore, the business model 2010 onwards has been minimal use of balance sheet, cross-sell. Look at ancillary business. Lending days are over, right? I want to give a loan to start a relationship, but I've got to look at how much other businesses I can generate, especially non-interest income businesses. Non-interest income is the buzzword in order to increase my return on risk-weighted assets. And therefore, every relationship manager we have by groups, looking after Tata, someone looking after Reliance, and so on, they're given an account plan. You have to prepare an account plan for the next 1 year, how much revenue you're going to generate from a particular company and from a particular group, and how much of that is going to be fee-based income. Because I want to consume little assets, I want to maintain or increase my RORWA, and therefore that'll have an impact on my stock price. The other thing is, most of the banks today want CASA deposits, current and savings account deposits, to reduce the cost of borrowing. Well, that's money, your current account, you don't have to pay any interest, right? So focus as much as you can on CASA deposits, and therefore you go to capture flows. Transaction banking is all about cash management. How you can capture flows. FIs are pumping money into India. Can they be routed through my bank? We keep a minimum amount of float. There are traders, brokers, and so on, stock brokers, who need to keep cash, right? They need to consume cash. There are traders, right? They want to keep some idle cash because they may need cash tomorrow, and so on. You got to capture transaction banking, cash management, trade finance, investment banking, fee-based. I get a fee-based income on an M&A deal that I do, or a loan which I syndicate, and so on advisory business. So I got to get capture maximum amount of fee-based income again in order to increase my ROA. So I don't consume assets. Structured finance are not plain vanilla deals. I can do a derivative, for example, a convertible bond or securitization of receivables and so on, which do not consume much of assets. So look at what's happened to Indian banking sector as a whole. Non-interest income to total income has gone up here, 27.54% in 2017 to 32%. And one of the reasons why they did is to meet the Basel III norms. The deadline was March 2019. It was extended by, this was prescribed by RBI. But then they extended for a few banks because of the COVID and so on. But all the Indian banks are home with having met their capital adequacy norms, Basel norms. And that's the reason why this fee income has gone up in order to meet the Basel III norms. We're going to have now Basel IV starting 2023. And that'll be an extension of Basel III. There'll be new standards for credit risk and so on. So overall, it's going to actually perhaps increase marginally the cost of equity capital for banks, right? So banks have to gear up to all these changes. There's also a new guideline which has come from RBI on opening of current account, because most of the banks want current account. You don't pay any interest, you get money for jam. But what RBI is saying is effective October 29, 2021, that exposure of the banking system to, if your exposure is less than 5 crores, basically to MSMEs and so on, there are no restrictions on how many banks can open current account. But if the exposure of the banking sector as a whole to a borrower is more than 5 crores, you can't have more than one bank. The reason being, they want to prevent free ride. Selectively only do cash management business without really committing assets. Better control of funds, and therefore, as a result of this, smaller banks will be affected. They will not get the CASA deposits. In India, we also had 2 years ago, merger of 10 PSU banks with 4 banks. And this is what was done. The finance minister had announced that in around 2019, but actually it took effect around April 2020. So these are the 4 large banks, and these are the target banks, and they all merge with these banks. So effectively, what we now have is PNB, the new PNB after merger of OBC and UB, second largest PSU bank. Then comes Canara Bank, new bank after merger of the fourth, it will be the fourth largest bank, right, after merger with Syndicate Bank, and so on, 7th largest. So what was the objective as the finance minister, Nirmala Sitharaman, et cetera, at that time? We want to create fewer and larger global size lenders to boost economic growth, to decrease unhealthy competition among public sector banks, to increase global competitiveness of Indian banks, and to take the step which will be in sync with the vision of $5 trillion economy by 2024-25. That was the objective, right? Now, the reason why this went off very well is because this government ownership, the salary structures are almost the same in all PSU banks, and there's a common core banking solution, right? And there are a lot of synergies, but more importantly, look here. We're looking at CRAR, capital adequacy ratio, or capital risk-weighted asset ratio. Yeah, United Bank 5.56. Because of the merger, it's been saved. For the banking, for these banks combined, it's 12.63. Likewise here, this was just around the what do you call on the borderline, and then it's gone up to 12.77 and so on. So it has helped some banks which could not achieve CRAR, or the CRAR was lower than prescribed by RBI. It helped the combined entity to improve their CRAR. The other important thing that happened in the Indian financial services sector was, the ILFS, which collapsed, in fact. And that had a tremendous impact on the NBFC sector. So RBI has been trying to harmonize, okay, guidelines between banks and NBFCs. So they came out with a 3-layer structure. Yeah, there are different types of NBFCs which are deposit taking, non-deposit taking, and so on. And then there are 3 layers depending on your size: base layer, middle layer, and upper layer. Upper layer are the large ones, right? And the top 10 NBFCs in terms of asset size, including HDFC. So therefore, what they did was they wanted to impose some of the regulations that they imposed on the banking sector to be imposed on the NBFCs. And therefore, liquidity coverage ratio was imposed. Again, you got to maintain certain amount of liquidity depending on how much outflows you expect over the next 1 month and so on. Also, in terms of Npa classification, they imposed certain norms which were similar to the ones which are imposed on the bank, which means that if there's any outstanding beyond 90 days, any repayment, that should be classified as an NPA. And that norm was quite stringent, the same as in the case of banks, right? And therefore, and also they came out with another regulation which says that banks with asset size more than 50, NBFCs rather, with asset size more than 50,000 crores may look at converting them into banks. So therefore now, this stimulated one of the reasons why HDFC merged with HDFC Bank is, one is a reduction in SLR and CRR, which was 27%, as you all know, banks have to keep aside or invest, right? 20 to 18% of their net demand and time liabilities in government securities, which yield low returns, an additional 4% as CRR with RBI, which doesn't earn any return. Right, so that has gone down because of reduction in interest rates, right? Second is PSL certificates have come, because one of the major problems faced by banks today, including some of the private sector banks, is how to achieve priority sector lending targets. I'll come to that. So therefore, it made sense here. Now the costs have gone down, so it made sense for HDFC to merge with HDFC Bank, and there are a lot of synergies there. One is that it becomes 6th biggest bank globally. You've seen all this in the media. 70% of HDFC Bank's customers don't have HDFC mortgage loans, and 70% of HDFC Group, right, entities do not have a bank account. So there are a lot of synergies here, right? HDFC does not have a housing loan book, although the HDFC Bank does give a loan, but they have to go through HDFC. That's the arrangement. Right, so HDFC Bank's loan book will now grow up significantly, 40% to 18 trillion rupees. Right, home loans will become cheaper to customers. Why? Why will home loan? Because HDFC bank has a lot of CASAs, current and savings account. That will reduce the cost for the consumer. Now, financially, look what's happening. HDFC Bank will become the 2nd largest bank in terms of total assets, almost twice as large as ICICI Bank, right? Now, you're looking at the financials here, you have SBI at the top, then comes HDFC Bank in terms of assets, then comes ICICI Bank. The difference here between the two is this is almost double, right? And if you look at the net worth of the combined HDFC Bank, okay, it'll be 3,12,504 crores, okay? And this its SBL is how much it can lend to a company. RBI rule says that you cannot lend more than 25% of your net worth. So therefore, HDFC can lend 78,126 crores to a single company or a group. Obviously, I want to lend that much. But it'll create headroom for financing, for example, infrastructure projects, which require huge amount of capital and investments. And also there are benefits for the shareholders and so on. So therefore, now the question is, what is this merger going to do to other banks? What's ICICI Bank going to do? What is Kotak going to do? What is Axis Bank going to do? Promoters may not want to dilute their stakes. Are they going to merge with other banks? Are they going to merge with NBFCs? We don't know at this point in time. At the same time, a lot of banks have entered into co-lending agreements with NBFCs to increase microfinance, MSME, and affordable housing portfolio. So therefore, this big gap being there has to be some restructuring, some consolidation happening in the banking sector. In which way, it's difficult to tell at this point in time. We also have, you've seen the last 2 years, a lot of foreign banks are exiting, especially in the retail banking space. If you look at foreign banks' share of advances among commercial banks, it was 8% in 2000. It's gone down one half, 50% to 4%. Private sector banks, their advances have gone up from 12.5 to 36%. So therefore, I look at Citibank. What's happened to Citibank retail banking business? If you look at 2018-19, revenues earned 34% of the total revenues, balance 46% was by consumer banking. 2019-20, this has gone down to 30%. This has gone up to 50%. Net NPA 0.51%, it's slightly gone up to 0.57. Return on assets retail 2.5%, it's slightly gone down. Interest income retail has again gone down. So therefore, Citibank was facing huge competition from other banks. It was a strategic decision. Okay, they've exited 13 countries across Asia and Europe, including India. And recently, they sold their retail banking business to Axis Bank. Why did Axis Bank buy it? Axis Bank bought it because I'm sure overall this portfolio would have been quite healthy for Axis Bank. More importantly, you need retail banking network to mobilize deposits. Where are you going to get the money from to lend in rupees? You need the deposit base, or you borrow in the interbank market. You need more casas and so on. So therefore, it makes sense for Axis Bank to buy that from the point of retail banking perspective. Then you have Barclays leaving, their Deutsche Bank, RBS, and so on and so forth. Also banks leaving in India. So what are the challenges that foreign banks are facing in consumer banking? Consumer banking, net interest margin is higher than in wholesale banking, but net basis, there are also credit costs, operating costs, and so on. So effectively, looking at return on risk-weighted asset is much lower than wholesale banking. Consumer banking used to be a hedge against wholesale banking because at least you had some steady income coming. Wholesale banking can be a little volatile during bad times, but at least here, that was a hedge, but that's not happening anymore. Consumer banking is asset consuming because all they're giving is loans all the time. You're giving retail loans, you're giving housing loans, and so on, personal loans which consume assets. Expansion through branches, capital intensive because of long break-even period. I remember in the 90s, BNP Paribas, they wanted to launch a retail campaign where they wanted to they actually floated a lot of branches in Mumbai city. And there was a champagne bottle. They closed the business within 3 years. Because retail banking is capital consuming and also highly competitive. So there's still competition and so on. Digitalization may make branch expansion redundant in future. So that's the reason a lot of foreign banks have rejigged their business models in India. They focus more on high value and cross-border corporate and investment banking and transaction banking. Exactly what I said before. But they want fee income, consume minimum assets, minimum lending, maximum fee income, for which you don't need big setup. You don't need branches, for example. Another problem that is faced is on priority sector lending. Okay, a lot of banks in India, especially foreign banks, so small private sector banks, they face problem meeting priority sector. The priority sector by RBI is agriculture, MSME, export credit, and so on. And these are norms that you have to fulfill. If I have 100 rupees deposits, for example, or a 100 rupee deposit, I have to invest 40% or lend 40% to these sectors. Again, there are subcategories. 18% should be to SME, to agriculture, and so on. 10% to small and marginal farmers. Micro enterprises 7.5. Weaker section of the society. How do I lend? How does a bank lend to these sectors? Unless, these are all based in rural areas, semi-urban areas. And private sector banks and foreign banks don't have the reach there, many of them. So therefore, how do you achieve this? Earlier, if you fell short of achieving this target, you have to invest in SIDB bonds. That was a penalty, which carried low rate of interest. However, right, RBI has come out with what are known as priority sector lending certificates. So there are instruments, for example, a lot of PSU banks overachieve their targets. And therefore, if they overachieve the targets, they can then sell their excess amount that they've achieved through this priority sector lending certificates to those banks which have underachieved. So what I have to do is, if I underachieve my target, I pay a fee, small fee, depends on demand supply. These notes are auctioned. So the RBI portal, eCuber. And then I then put in, let's say I'm falling short of 100 crores. So I'm falling, let's say 10 crores. Then I buy those PSLCs from another bank which has surplus. I pay 0.25% on 10 crores. I don't buy that. I don't keep the asset in my books. The question is this financial inclusion? Therefore, there's incentive for large banks, the PSU banks, to overachieve their targets and then sell the excess that they have in the form of these certificates to banks who have not achieved. Right now, my question is this financial inclusion? That's a big question mark, right? So if you see the data last 2 years, public sector banks have achieved more than 40%. The shortfall comes from private sector banks and foreign banks. And how do they meet the targets? By buying PSLCs, which exactly is not, in my opinion, priority sector lending. You're trying to do something to get a fee income and then sell your excess, but how does that money in the end go in the hands of the priority sector constituents, right? Each bank has to do it on an individual basis. And then you have a lot of schemes by the government of India and so on. So that's financial. Now comes the MSME segment. Now this is how micro finance is basically if you have investment, plant and machinery less than 1 crore, turnover less than 5 crores. Small enterprise is where your turnover is less than 10, less than 50, and your investment in plant and machinery is less than 10. Medium is just less than 50 and less than 250. These are the MSME segment. If you look at the growth rate in terms of how much formal credit has gone to the sector between 2004 and 5, this is billions of rupees. The CAGR is 23%, which is humongous. Now, the important thing about MSME sector and the Indian economy is it accounts for 30% of India's GDP last year. And that's expected to increase to 40% by FY 2025. These are projections given by the Ministry of MSME, Government of India. It grew at 23%. We saw that between 2004 and CAGR and 2020-21. There are 65 million or 6.4 crores MSMEs in this country. Out of that, only 23% have access to banking facilities. The balance 67% get financing from unorganized sources like money lenders, relatives, friends, and so on. Money lenders charge huge interest rate, 23, 20, more than 20%, and so on. Therefore, financing is a challenge here because the credit gap, as per the estimates of the Government of India, is almost $219 billion. And there are problems here because MSMEs are not dependent on bank credit for the following reason is lack of timely availability of credit. They don't rely on banks because of lack of availability. Issue of collateral, no bank is going to give it without any collateral, so the money lenders do it. Procedural delay and information asymmetry because they may not have all the information. Many of them don't have financial literacy, for example, and they don't understand the products and so on. Likewise, banks also face problems. They are high-risk borrowers, and therefore that may result in NPAs. Assessing creditworthiness difficult due to information asymmetry. Again, customers' lack of banking knowledge of banking products. So all this combined have a huge impact in terms of their lending. What's the problem here? Okay. So financing, it becomes a challenge, right? So there's enormous scope here for financing the MSME segment, and that's where I think fintech can come in. Definitely, if you want to transform India's economy to $5 trillion by 2025, I think we need to speed up this effort. Now I'll talk about lastly on technological changes, fintech, collaborative or disruptive. Okay, we're looking at the history. We have 1980s computerization. I remember my days. I was telling Dr. Bigyan that when I started my career in ICIS in 1983, there were no computers. So we had to do physical cash flows, right? Physical cash flows, physically, I mean, using, manually rather, no computers. Then we had core banking system in the 1990s. We had ATMs in 1987. We had mobile banking in 2000, then digital banking 2011. And that has come about primarily because of the GFC, global financial crisis. Okay. And this is what the path has been, how transformation has happened, mechanization, automation, internet, and then mobile digital banking. Okay. And more importantly, we find that the rural tele density has been increasing. We see here It was 39% in 2012, 59%, which is a good sign in terms of internet banking. Whereas fintech funding, look what has happened to fintech funding. Total funding of 16.5 billion between 2016 and 2021. That is up, out of which 60% was during the past 3 years. Okay, these are official figures got from our private equity fund, which is actually investing in fintech. So total funding, fintech 23.7 billion raised, right? Out of that, it's grown at a CAGR of 14.81%. Now, the funding has given rise to 10 unicorns, which include Razorpay, Cred, and so on. These are all fintech companies, Policy Bazaar. Unicorns are soon going to become unicorns, and minicorns are going to reach $1 million. They already reached $1 million, right? So if you look at the India's fintech market size, third largest fintech ecosystem in the world in terms of value of transactions. Okay, fintech market was $31 billion in 2021, about 6% of the total financial services sector, which was $500 billion. They expected to grow at a CAGR of 22% over the next 5 years. It's a largely an untapped market, right? Now, look what's happened to digital payments in India. From, if you take March 2018 as the base, it's gone up from 100 to 270. Increase by 170%, right? And look here what's happened to UPI. UPI is 16/7 UPI was formed. It's gone up to here in terms of volume in millions, right? This is value in millions of rupees. This is volume. Tremendous jump. 126% CAGR between FY20 to FY22. There's enormous growth in terms of payments, and most of these payments you'll find 50% of the transactions done through UPI are below rupees 200. This is official data. I've taken this from the economic survey. Number of banks in UPI have also increased, right? So therefore, in fact, the digital ecosystem, fintech, has done a lot of good for the Indian economy, right? It's growing at an enormous pace. You have on one side fintech, you have financial services. On the other side, you have technology. You have banking, insurance, asset management, capital markets. You have omni-channels, you have big data analytics, cloud technologies, APIs, and so on and so forth. And on the customer segment, you have individuals, you have SMEs, and you have corporates. Now, there are different segments in fintech that you see: paytech, payment companies; lendtech, who are lenders; insurance tech, involved in insurance business; wealth tech; reg tech, and so on, regulation. If you look at segment-wise composition of fintech business, 6,386. Okay, out of which, if you look at percentage term, payments and lending is huge. Then comes investment tech. So payment and lending together is about 43%. So there's another thing you got to know is that there's a huge untapped opportunity due to low penetration, right? You look at unbanked population in India is 14.6, almost 15%. In US, it is 6. SME which have access to credit, we saw that before. India is 20%, US it is 87. Insurance 3.7, US 11.4. So there's no comparison at all, which only shows the future potential for fintech. Digital lending is growing at a very rapid rate. Okay, CAGR between FY19 and FY23, this is forecast, is 33.56%, $350 billion. Okay, these are official figures. Digital lending to the MSME is expected to be about $100 billion, right? So therefore, okay. Now the future services banking, 95. This is 350 billion, 95 trillion. 12.5% is the compounded annual growth rate. Wealth management about 15 billion. So there's a huge demand from the banking sector, lending, insurance, and wealth management. If you look at the favorable ecosystem which will drive accelerated growth, India has very high internet penetration, 845 million people, internet users. Middle class expansion by 2030, India will add 140 million middle class income and 21 million high income households. And a lot of favorable government initiatives like Digital India, India Stack, Open API platform, Startup India, Aadhaar, and so on. They're giving a boost to this particular sector. Few of the fast growing payment fintech companies in India. Topmost is Paytm, then comes BillDesk, then comes Fine Labs, then comes Razorpay. Right? These are sort of the four largest. In fact, Paytm is India's leading payment and fintech enterprise. It offers payments, broad range of financial services, commerce and cloud services to its large customers. Its gross merchandise value greater than 4 trillion rupees, 33% CAGR for FY 1920. Payments and financial services contributed to 75% of the total revenues, right? So it's created a payments-led super app and other payments offer, and it offers payments, credit, insurance, merchants, wealth management, and a host of other financial services. It leads the market in peer to merchant space. It got a banking license, yeah. So, but however, it got a banking license from RBI, but it can only collect deposits from customers. It cannot lend on its own balance sheet. It's a large distributor of mutual funds as well. Look at the financials. What's happened last year? This is before the IPO. Look what's happening to the bottom line. In rupees, this is taken from the offer document, from the prospectus. Huge marketing expenses. Okay, so EBITDA is negative. The question is, when will Paytm make money? Right? The advantages of fintech in the banking space. There are several advantages because there are problems which are faced by the customer, and there are a lot of these applications are very user friendly. I've never used any of them, by the way, so my knowledge of the sector is not really that profound, but the data that I've gathered here is based on the secondary sources, right? I never used mobile apps. I used my computer or my tablet to make payments and so on. Somehow I'm not, although I have a smartphone, but I don't use it for payments and so on for some reason, right? So problems faced by customers, fintech covering all those problems, and here we have the key advantages. Users are glued on to those apps because they say there are a lot of cashbacks or goodies that are given. More importantly, very user friendly, right? And that's why you keep on using those apps. So if you're looking at what's happening, cost saving is happening, obviously is good. Automation reduces cost. Branch expansion in consumer banking is expensive, reducing cost. It reduces the cost of financial intermediation. At the same time, it's increasing efficiency. We all know that. Faster rate of approval for finance or insurance, reduction in delivery turnaround time, simplified or more user-centric approach. So now what's happening in the actual industry? Fintech no longer viewed by banks as disruptive forces. Recent evidence points towards collaboration. Synergies to be explored between fintechs and banks. What are the advantages? Fintechs that possess vast technological knowledge, lack clients and expertise to navigate regulations. Many fintech companies are burning cash. Banks have a pre-existing client base and customer knowledge. Customers belong to the bank. They have capital and can weather intense competition, which can be of immense value to fintech companies. Banks have knowledge of risk management, local regulations, and compliance. Okay, and therefore, if both of them collaborate, you'll really create a fantastic platform, digital on one side and the bank on the other side, technology on the bank, which will help deliver end product or service to the customer efficiently and in a cost-effective manner. So the strategic collaborative partnership between the two would enable them to realize the respective core competencies. Payment banks can operate as a business correspondent to large banks. So with payment banks, with commercial banks, definitely will help extend credit to remotely banked areas and to MSMEs. And there's other partnerships which happened last year. This is all there in the public domain. So many banks are collaborating with fintech companies, right? And in different areas, banking or in insurance or wealth management and so on and so forth. Now, the biggest scope, as I said before, where fintech can really help us is to penetrate to MSMEs. And as I said before, that they accounted for 30% of India's GDP in 2021. They grew at a CAGR of 23%. So this is, if India has to get past 5 trillion, I don't think you can do that without reaching the unbanked or the underbanked segments of the economy, the MSMEs. Out of 6.5 crores, 23% don't have access to banking facilities. Balance 67% get financing from, as I said, unorganized sector. The credit gap is huge, and if you have digital tools like artificial intelligence, machine learning, data analytics, and so on, which can enable you to reach the MSME segment, the underbanked segment. You can actually construct the credit score, the credit profile based on all the technology that you have. That will enormously help us, increase our the contribution rather of MSMEs to our GDP. Okay, so there are fintech companies which are actually being which are catering to the needs of the MSME. There are some of them which I got from one of the presentations by Ernst & Young. Now, I haven't checked the facts. I've just taken, I assume it's authentic, where these particular fintech companies are working with the MSME segment. One platform is Trade platform is an electronic platform, digital platform for discounting trade receivables for financing of MSMEs through competitive bidding. And this is being used by a lot of banks, including the PSU banks and foreign banks and so on. So the whole objective here is to help MSMEs sellers to quickly realize the receivables, but also from a cash flow perspective. It will also result in efficient price discovery because this will be through auctioning system. Then there's a platform called PSB Loan in 59 minutes. It's a portal, which is again geared towards the MSMEs, wherein within one hour or 59 minutes, a bank can give an in-principle approval for loans for 1 lakh up to 5 crores can be availed to this. And the final approval will take not more than 7 to 10 days, right, for disposal. Then HDFC has come out with a 3-hour approval process. Through analytical and digital approach, they can focus on MSME segment. They have a lot of customers on board. And then they have a system generated sanction letter documentation, total approval time, 3 hours. So therefore, fintech is definitely transforming the way business is being conducted, especially vis-a-vis the unbanked sector in India, the MSMEs and so on. Now, the only concern here could be the impact of fintech on financial stability. Okay, what's going to happen to financial stability? Lending standards could weaken due to wider credit access, perhaps. This is what the regulators fear. Lending from debt and equity rather than deposits would make it pro-cyclical due to lack of standard credit guidelines, because RBI comes out with standard credit guidelines in terms of the SBL and so on. Credit activity outside the prudential regulation space could lead to financial stability. And more importantly, cyber security. How do you protect customer data? How do you fend cyber attacks? Recently what happened to Paytm, I'm sure all of you are aware that RBI imposed a fine of 1 crore rupees because they found that a lot of data was leaked to Chinese apps and so on. So whether it's true or not, although Paytm has denied it, I'm sure RBI would have had some evidence, and therefore customer data protection, fending cyber attacks is of critical importance. Now, if you look at what RBI has done, as this is the latest guideline they have come out. This is a circular on establishment of digital banking unit, 7th of April, just about 3 weeks ago, right? Because Government of India and RBI, they want to promote digital banking. They want digital banks to extend their reach to the unbanked areas, particular to MSMEs. But at the same time, they've got to ensure that everything's hunky-dory, that, there is no financial instability, there's no leakage of information from the customer perspective and so on. And therefore, they come out with guidelines just around the circular about 2 or 3 weeks ago, which says that, and this is in line with the recommendations of a working group formed by RBI on November 18, 2021. And sub-segment of retail banking. So basically, digital bank will be considered as a sub-segment of retail banking for the purpose of disclosure under Accounting Standard 17. Scheduled commercial banks other than regional rural bank, payment banks, labs with past digital banking experience may be allowed to open DBUs. Minimum products and services on asset liability side to be offered. Okay. In addition, there's one part of that circular which says there should be a separate entrance and exit for the digital banking unit. So I don't know what the logic here is, but SEBs can set up digital banking unit as a separate unit within their existing framework. If you're looking at the future of Indian banking, then what conclusions do I draw based on what the facts that I've presented? So large cap and top tier mid cap companies will rely more and more borrowings from money and capital markets because of financial disintermediary, which is good for banks in a way. Commercial banks have changed their business models in compliance with Basel III norms from asset heavy to asset light models with focus on cross sell and non-interest earning business. And therefore, you don't need a huge setup. Getting fee income is competitive. Based on my experience, Indian companies don't want to pay any fees. Very few. Or they'll negotiate hard for the fees. What you need to survive is to sustain a top line or revenues through interest. But again, there's a cost attached to it. So the competition will be more stiff now. Basel IV now norm could further tighten the capital requirements for banks. Tough times ahead for foreign banks, especially in retail banking space because of the stiff competition. Merger of HDFC and HDFC Bank will increase the momentum for growth through consolidation. We saw a huge gap between SBI number one, then comes HDFC Bank merger with HDFC, and then whose size will be almost double the size of the third largest, which is ICICI Bank. What will other banks do? And therefore, distinct segmentation of the banking sector may emerge. On one hand, you'll have large Indian banks with domestic and international presence. Maybe there could be more mergers of PSU banks happening. There'll be several mid-sized banking institutions with national presence. There could be smaller private sector, small finance banks, regional rural banks, and so on. Cooperative banks need to focus more on smaller borrowers in unorganized sectors. Digital players who may act as service providers directly to customers or through banks, acting as agents. There could be some turnout here as well. Maybe some of the fintech companies may merge with others. It happened in the case of the telecom sector in the 90s, right? Or they'll work more closely with banks. They may be taken over by banks. We don't know what's going to happen. Achieving priority sector lending through direct lending will continue to be challenging. That's where digital banking comes in. So digital banking will help banks to extend their reach to rural and unbanked areas, and in particular the MSME segment. And therefore, the recent trend points towards collaboration between fintech companies and banks. I don't think fintech companies can survive on their own. More of them are cash burning. We saw that. Recent RBI circular on digital banking would lay the roadmap for future growth of this sector. So these are the observations based on whatever I studied. Part of it, as I said, was based on my experience, primarily wholesale. I've never worked in retail banking. And therefore, I just put together a presentation where I put together my facts and so on, my experience. And this is what I feel is going to, it's very difficult to predict what's going to happen in another 5 to 10 years, but these are the emerging trends and the challenges that are faced. Right, so I've completed my presentation within 1 hour. Spot on.
Spot on, absolutely spot on.
Yeah, it was 24 pages, mind you. It's not a small
wow,
book.
that was good. That was so nice of you. You know what? My quick observation, Dr. Tinaikar.
Yes.
You know, like the enormity of the coverage of your presentation is absolutely fabulous.
Thank you.
You know, it made me feel as if you're taking me down the lane of history of the Indian banks and how they changed and evolved over years, and the kind of challenge they faced over years, and also the Basel 1, 2, 3, and now on the verge of 4.
Yeah.
Can I ask you a question?
Sure, please.
I put that on the chat box also. You know, the digital currency, which was launched in the recent budget by our finance minister as a central bank digital currency, is expected to meet the 3 imperatives of competition, data privacy, and integrity, encompassing the money laundering, financial crimes, and etc. etc. Now, that's the centrality of the entire digital currency we are talking about, right? How do you think is going to impact the banking industry in the days to come as such, especially the fact that everything has become digital, especially in the banking industry?
Exactly. Basically, what it will do with settlement will be instantaneous. Earlier, there's been settlement, there won't be any settlement risk.
Okay.
I think that's a major thing. And in terms of contribution, it will bring about more efficiency because digital currency, everything is virtual, right? As from what I read from the RBI initial paper was that it can be converted to cash if you wish. But it'll definitely, I think it'll increase efficiency into the system, because one is settlement time will be absolutely zero. Today you have settlement, T+2, T+3, it'll be instantaneous, right? So from that point of view, it'll increase efficiency. But one has to come, wait for further clarity on what the exact guidelines will be on this virtual currency, because this is what I gather based on what I've read. RBI is working on it. We still don't have clarity. But in terms of as a banker, I can think of one important thing. Risk is a settlement risk, which will be eliminated completely.
Okay.
That's a basic advantage. But for individuals, maybe a salaries will be paid through a digital account, right, in this virtual currency. And the question then is, how much can I convert into cash? Am I allowed to convert into cash if I want to make cash payments? Or will it have to be then, if I have to pay somebody else, it'll be purely through a mobile app or something, digital transfer, the virtual transfer from my account to somebody else's. I don't know. But that's
okay. So is that likely to be based on the blockchain technology?
Yeah, exactly. Blockchain. They're going to rely on blockchain. That's what it has been said. More importantly, the cryptocurrency, I honestly believe it's an asset class. And as the finance minister has rightly said at the IMF forum recently, that there has to be a common set of rules or regulation as far as crypto is concerned, whether it may result in money laundering, it may result in terrorist funding and so on. But I think the virtual currency will eliminate all that. We are a technical expert. Maybe you can then, since you work in this field, you may want to add to what I said.
Sure. I think Dr. Kiran wants to ask a question.
Yes, please. Go ahead, Kiran.
Excellent, run through the banking system involvement in our country. I think very crisp and precise. Took me back to 1981-83 when we used to be part of your team for presentations. I think the whole process I can now see is almost as crystal clear as you were back then 40 years ago. I have a question, Durgesh. We've just recently heard this outburst of, Bharat Pay and, the multiple levels of, transactions that is, now opening out to say that how these were manipulated and put into the system. And also that, to be able to gauge them, to be able to bring in a certain amount of stability into the system, because the banks are heavily leveraged with their fintech companies today. What do you think is likely to be the impact of incidences like that? Is it an aberration, or do you think that in the future, this could become more of a norm unless the systems are absolutely geared into being able to capture these sort of internet-based banking frauds?
Yeah, good question. Actually, I also read
Dr.
that.
Durgesh, can I first of all request you to stop the presentation so that you can have the entire screen?
Wonderful. Thank you. Okay, now we can see each other. Thank you.
Yeah, much better. Yes.
Yeah, so Kiran's question about Bharat Pay, I think some consumers have launched a complaint with RBI, right? A lot of digital payments, in fact, they were given loans when they're not actually access. This is what I read in the newspapers. I don't use any of these apps. And RBI is examining on how to make this, technology-wise, how we can make it foolproof. Cyber security is very important. That's the major worry. So I don't have, honestly, Kiran, I don't have any, because I'm not a technocrat, so I don't have any answers to this. But RBI, as per my information, RBI is examining into this aspect. And one thing in the digital banking is that from the guideline or the circular, it says it has to be in-house within a bank. So these neobanks, there are a few neobanks, but they cannot operate on their own. They have to tie up with a bank, right? RBI does not allow them to operate independently. So whether neobanks will merge with these banks, and therefore, because see, banks have knowledge of regulation, they have built up technology, although fintech has gone ahead of them in terms of technology. But banks are investing millions of dollars in technology, right? So the only way, the way forward to addressing this kind of a problem is a more intense collaboration with the banks, between the banks and the fintech companies. That's all that I can say at this point in time, because these kinds of hiccups are going to happen all the time. There's no controller. There has to be some regulator somewhere. Fintech companies not regulated by RBI except Paytm, which has now been given a bank license under Schedule 2 of the RBI Act of 1934, but only with certain restrictions. So RBI is also looking at even how things are happening, and definitely they will come up with certain more stringent regulations in terms of today. What are fintech companies? They are basically payment, right? Remittances, payments. Of course, they're doing other functions as wealth management and also buy now, pay later. Buy now, pay later is a platform where, based on my knowledge of what I've been reading in the press, a lot of consumers have faced problems. But there are no loans are given. There's no buy now, pay later. Why am I being, charged for that particular user? I think Dr. Bigyan will be able to perhaps address this question more, since you are more tech savvy than I am. But this is the information that I gather from what I.
So, sorry, just to, if I may, Mr. Bigyan Verma, two factors. See, the scope for manipulation by a fintech company, in the digital world is multifold. And when this partnership is in place, okay, because see, there are two issues. One is the customer complaints, and the other one is where it's actually fraud internally generated.
Correct.
So do the banks per se now, say for example, the exposure like Axis Bank and State Bank of India have a huge exposure, with these. So in your opinion, is there any system that needs to be, evolved for the banks to be able to ensure that they don't get manipulated?
Well, that has happened. You see what happened to HDFC Bank. It was fined by RBI, right? A few months ago, in fact, about a year ago, they were stopped from, issuing more credit cards. Their technology failure. My bank, Mizuho Bank system failed thrice last year.
Right.
So the chairman was sacked. Now, I don't have an answer to this question. It's a technology-driven question. It has happened with my bank. Imagine, a Japanese bank is supposed to be foolproof, conservative. But the chairman lost his job because it happened thrice in Japan. So I don't know what to say. Well, that's where the bankers and the technology people have to sit together and see how we can really solve this problem. I don't have an answer offhand, honestly. It can happen. It has happened. Even in India, HDFC Bank, RBI fined the can't because the system failed about a year ago.
Sure.
Right?
Because they're in the news.
Thanks for the clarification. Thank
you. But I don't know whether I've clarified. I am just trying to open some questions.
But
maybe some technology person can perhaps clarify this better.
The clarification that this area still is a bit cloudy.
It's a cloudy. We are on a cloud server in the wrong sense.
Dr. Saab, one more question. Can I ask you?
Of course, anytime.
Do you think because of Basel III, the cost of borrowing has gone up? Yeah. And Basel IV is going to be even more harrowing.
Slightly more.
Yeah. Well, that's going to be dangerous for the economy then.
Not really, because see, basically, as I said, banks have already shifted. You look at Citibank in India, what it's doing.
Yeah.
It's raising bonds for India, doing a lot of fee-based income, businesses. For example, when they raise bonds without giving any credit previously. Because they have captured that segment, whether it be advisory services, whether it be capital markets, they're the leaders. Okay. So you have to evolve your model and see how we can, step up and, reach to that level. They have all the skill sets. They have the technology, they have the skill sets, they have knowledge of the markets, and they're getting business right, left, and center.
Yeah.
Yeah, which is fee-based income, non-interest income without giving funding. So what they should do earlier is, example, let's say an Indian company wants to raise an offshore loan, let's say 200 million, 300 million or whatever, right? And then what they do is, they will take the part of the loan in their books like other banks do, and then they have a back-to-back arrangement to sell to somebody else. They'll never own their portfolio. Many banks are not capable of doing that because they have a very active secondary trust. The loan market is not very liquid like the bond market. So they'll show, okay, I have a relationship with, I give you a loan today, but later on they'll say, look, I need to churn my portfolio. So if you have assets in your books, you have to churn your portfolio frequently.
True.
Okay, that's where the skill lies. Stanchart is doing it in India.
Very true. There is one observation by Mr. Shyam Talwardekar. He
Yes.
says that the fintech MPA seem to be higher than banks because of lending to SMEs. Is that correct?
Before that, there is a question. This is
Yes.
a continuation.
Sure.
The sentence
Please
is a
carry on.
continuation.
Can you carry on?
Yeah, there is a question in the box itself. What I said is there are some fintechs.
Yeah, sorry.
Yeah, there is a tremendous scope for the fintechs. The SME sectors being underserved, as he rightly said.
Yes.
Right.
Will they make money by when? What's the experience in forerunner countries, of such fintechs? And fintech NPAs, in fact, seem to be higher than the banks themselves because the lending is to SMEs. Yes, shoot.
No, not fintech, because anyway, fintech companies have to be linked with the banks. If you look at the experience in the US, the reach is much greater than in India. Okay, from what I've read. But as far as India is concerned, the reach will be much easier because without having a branch, if you have artificial intelligence, you have data analytics and so on, machine learning, which can do a credit score or a credit profile. The question then you're going to trust on technology, right? It'll definitely help you reach out there to get you better assessment of credit score, credit risk rather. Okay, so what you're saying is right. MSME has contributed to a large proportion of NPAs. And so it's a kind of, as we call it in the banking terms, a twin balance sheet problem. Twin balance sheet problem is one where you don't want to lend. Banks are a bit reluctant to lend because there'll be NPAs. At the same time, they have to clean up their balance sheets. At the same time, companies are highly leveraged because many of them, the loans that are given in the unorganized sector, they're not secure.
So true.
Yeah, so therefore, if a bank wants to come in, then how do we ensure that, will they give security to banks? A lot of it is based on cash. How do you convert that cash-based business into a digital business? And that can only happen through trades platform and so on, where you give opportunity for discounting to the digital route. So it's a big challenge, but it will definitely, unless fintech collaborates with the banking system, you cannot reach that segment. It is too early to say what's going to happen, but I think if artificial intelligence and all your high-tech applications will help us address that problem, that's the only way forward. Otherwise, the what you call the vicious circle, twin deficit, twin balance sheet, high NPS, I don't want to lend, right? Highly leveraged, companies cannot borrow. And therefore, as I said, if technology can help us bridge this gap in some way, right, without having more branches, I think that's the way forward. It's still preliminary. I mean, these are ideas, these are what has been explored. There's not much, immense progress, but there's a huge opportunity in this segment. That's what I can say at this point.
Yeah, fintechs actually, due to technology, they are bringing in the SMEs which are otherwise not accessible, but out of 100 rupees which are lent to them,
correct,
80 rupees are still the liability is with the banks, am I right? And 20% or maybe, is with the fintechs. But then is there an experience of these fintechs making money from the forerunner countries? I mean, they were in developed countries before India. So
yes. There have been cases. I mean, I can't exactly tell you, but they're the technology, and they're the SMEs in India. It is not a cash-based economy. Their technology is not advanced, right? We have our own set of problems. How many ATMs reach the underbanked? How many of them access to smartphones, to mobile phones? So definitely the success rate is much higher there, undoubtedly. But India is a different country. 2/3 of India's population lives in rural areas, right? And they contribute to almost 40% of our GDP, 30%. That's where the challenge comes. So you cannot really compare the American model with the Indian model. But definitely fintech will help us bridge the gap. We're all optimistic about it.
Okay.
Sometimes I feel, sir, that it's a big bubble, because look at the new kid in the town called Cred, has a valuation of $6 billion.
Yes.
Is planning to raise $300 million in the next few days. And I don't know how they make money. I really don't know how do they make money. Though I have subscribed to it's there, this application there is on my mobile, but it beats my, whatever thinking I have. How do they make money?
I don't think they're making money. Paytm is losing money. The loss
Yeah,
is
absolutely.
they've reduced their cashbacks.
Absolutely.
The question then
Kiran sir has a question. Kiran sir.
Yes, go ahead.
As per the norms and what the RBI has set in terms of priority lending to agriculture and MSMEs, which it says 7.5% and 18%. Okay, if you look at actuals, whatever little I understand and whatever little I know, the banks never seem to be anywhere close to achieving those targets. Okay, and they remain as supposedly guidelines or requirements, but as you pointed out, the reluctance to lend on the lower scale and charter into unforeseen territory is very very much there. So what and then if you look at the fact that we are anticipating at a 40% GDP growth, or at least 30% of it should come from MSMEs and other sectors, then how does one balance? Because do you think that that ratio is being met, or it's
I showed in one of my slides what they're doing is the surplus banks are issuing an RBI's formally, it's totally legal. They issue PSLCs, priority sector lending certificates. Earlier, there should be carbon credits, if you recollect. So that means if I overachieve my target, I have a target, PSLC target of let's say 100 crores. But I overachieve it, I say, assume I lend to 130 crores. Assume. The 30 crores surplus, I will sell it to other banks for PSLC. Whereby what happens is the asset remains in my book, but I'll be given a fee income for it. If I'm having a shortfall, and that's the problem I face all the time as a foreign banker, everybody does it. HDFC, the merged bank is going to do it. So that means they're buying excess from someone else by paying a fee. That's why I put a question there. Is this financial inclusion? The only way in which it can be reduced broad on scale is through your fintech, which you can directly reach those customers.
True, but is there actually many banks that are excelling their targets?
Oh yeah, most of the PSU banks have SBI, Bank of India, Bank of Baroda. So the private banks also.
Because whatever little I have seen, they always seem to be short of those targets.
No. I showed you the slide where we saw the excess. I showed you one of the slides. So there's been excess from the PSU banks. There's a shortage on the other side, and you get it through PSLC. So it's some cost for me, which is fine. If I were to invest in a SIDBI bond at 3% for 5 years, you do the cost benefit analysis and see which is more attractive. And that's one of the reasons why banks like First Frank Bank and all left India. What happens is the banking space has become so competitive, you can't make money out of a Tata, Birla, or a Reliance, or the PSUs, or a LNG. So you're going to go down. They invested 35 crores to IL&FS. They took a big hit in that.
True.
Okay. Go ahead. Sorry, Kiran, you want to say something?
It's very similar to the airline industry, where you are expected to fly 35% of your route to priority sectors,
right,
which are basically non-profitable. So if you don't actually fly those routes, you can buy credits from the other airlines.
Exactly.
But most of them struggle to even make their own target.
No, here targets are slight shortfall is there, as I showed you in that slide. Those are RBI numbers. They still can, there are a segment of the banks who still cannot, despite buying PSLC certificates, because they find the pricing not attractive. Perhaps I don't know.
So I think time flew. We started sharp at 6:30, and it's almost 8 o'clock. So 90 minutes of intense discussion, wonderful presentation, and which took us through right from the beginning to the banking industry to where we are today. And I'm sure, Dr. Dugesh, the way you projected things, scenario for the bank, things will evolve that way itself. So thank you so much for your time. Thank you so much for such a wonderful presentation. And on behalf of our president and all members of the executive committee and other members of BMA, I'd like to sincerely thank you for taking out time for this extremely insightful presentation on the future of banking industry in India. Thank you so much, sir.
Thank you very much. It's been my pleasure. You made my evening. Thank you very much. I hope I can share it. I'll share the presentation for the benefit of all, and you can then share it with the participants or whoever.
That'll be very nice of you. You can share this with the office for BMA, and whosoever wants it will take it. In any case, the entire presentation, the talk will be put onto YouTube for others to view anytime. So it'll be archived, it'll remain over there. Anyone can access it anytime they want.
Thank you very much. Thank you so much.
Durgesh, you want to say something?
Durgesh, if I may just share with you, BMA YouTube channel, gets more highly utilized than the actual sessions. We get at least 2.5 times the audience actually coming in and looking at videos post the session.
Absolutely.
For various reasons.
And I can see a lot of comments from various people who attended this talk. They're all saying thank you, great insights, and so on and so forth.
Thank you very much. I wanted to optimize. I was a little apprehensive whether I'll complete within 1 hour, but I managed to complete, I think.
Oh, you are an experienced banker and a professional and an academician, so I'm sure you will know it.
Thank you very much.
Thank you, sir, and good night. Good night, Dr. Kiran, and good night, everyone who is attending the talk today.
Thank you so much. Thank you.
Thank you.
Thank you. Bye.